Hello and welcome everyone to this session on the exciting tech ecosystems developing here in Europe. We're going to spend half an hour talking about the rise of European unicorns. What's exciting about the European tech ecosystem is that we're seeing a number of hubs coming up all across Europe. I'm delighted to be joined by two of the most successful growth investors here in Europe. So Fergal Mullen, who is a founding partner of Highland Europe, Omri Benayoun, who is a GP at Partech Growth, and one of the, if you like, founding fathers of entrepreneurialism in the Nordics, Kristo Avaska, who is co-founder and CEO of Smartly.io. Before I jump in, just a couple of statistics for people to bear in mind. According to Crunchbase, there is roughly 86 unicorns in Europe today. That's at the end of Q1 2021. I know for a fact that has grown materially since that date. And in fact, there was about 16 unicorns created in the first quarter, which is actually up on the whole of 2020. And extraordinarily, it's estimated there's over $20 billion of investment in the European startup scene in Q1 2021. Again, that's a 130% increase on 2020. So it's exciting times, and hopefully we can unpack in this discussion some of the themes that are driving that growth. But maybe firstly, a question for Fergal first, and then Omri. I've given you some data about the growth of the unicorn scene in Europe. It would be wonderful just to get some real live kind of updates from you guys, how your portfolio has developed in the last few years, and if you're seeing that explosion of growth and unicorn creation that the others are talking about.
Thanks, Ben. So we've got 4 funds that are currently live. Funds 1, 2, and 3 are of an age where I could actually use some data. Fund 4 is literally just commencing its investment cycle with 4 investments to be announced soon. In the first 3 funds, which are vintages 2012, 15, and 18, we backed actually 15 companies in each fund. And so far to date, we have 9 certified unicorns, 3 of which are fully exited, 4 partially exited with lots more upside still to come because we're holding very meaningful stakes in those companies. And in addition, we have, I think, 4 what I would call almost certain unicorns, but they don't need cash. They haven't needed to finance. But if they were to sell today or in the next year, they'll be in the 1 to 3 billion range. And then we have another 3 or 4 that I would say are within reach. So I'm quite certain that cohort of 45 companies for us will generate minimum 15 and potentially up to 18 unicorns.
Thanks, Fergal. Omri.
Great stuff and impressive. I'm a big fan of Highland. Actually, I think they started the whole growth thing in Europe before everyone, and they've been doing fantastic. Look, on our end at Partech, I think we started, let's say, January 1st of this year with 1 unicorn, pretty big one, but in South Korea, and still 8 days to go to the end of June, but we should be at 8 at the end of June. And so, there's been a massive increase in the number of unicorns we have in our portfolio. And actually quite a few of them are not, 1 billion, but, 3, 4. So I think we've seen this massive increase in number and value as well. And I guess in a similar fashion that Fergal was describing, we actually have quite a few that are not technically unicorn because they don't need to raise, and so there's no external pricing. But we're pretty convinced that this number is more or less double when you add those very cash efficient companies that when something happens would be above that. So the massive acceleration that you were mentioning, Ben, we can see it in our own garden, I'd say.
Perfect, thank you. Right, as a theme we'll come back to, I think, is this whole concept of perhaps founders being more expansive in their ambitions these days, and the days of just getting to a unicorn is probably over, and people are trying to get to multiple billion-dollar or multi-billion-dollar companies. Before this session, Fergal kindly, actually, we had an exchange with Fergal around what are the success factors for an environment where we can sustainably generate high value tech companies at a similar rate to the US. One thing I should have said at the beginning is Europe is definitely behind the US in terms of per capita creation of unicorns, but we are catching up. And I think framing this discussion, let's maybe talk about 4 things that will help that sustainable unicorn creation. 1 is team, 2 is product, service or concept, 3 is sort of plan stroke execution, and then 4, importantly, is the exit market and the capital markets. And perhaps, Christo, maybe turn to you just to talk about the concept or the theme of team. I'd be very interested to get your observations around how the talent, if you like, for tech companies is developing in Europe, and how hard it is to hire, and how you actually go about hiring talent versus all the other tech companies in Europe as well.
Absolutely, Ben, and it's a great question. I think in our business, the talent is everything, and the most important thing to enable you to succeed in the long term and to build a company. And what we found is that it's really spread out depending about your market and also about your function. I do think that, for example, engineering talent, we have tons of great engineering talent available, even in Helsinki and in Eastern Europe, who are willing to move to Helsinki or build to a company. So that's great. And it's actually a competitive advantage against a lot of US players, for example, that we have better and also more affordable and more loyal tech talent available. So that's great. Then I think in whole in Europe, we have great business leaders and business people to crack the European market. And for the first 5 years, Smartly was really successful in Europe, and we were able to build up the business and hire people both in Finland, but also Germany, London, and Southern Europe to crack that business locally. So there is great talent available for that. But then in our space, in online marketing, social marketing, and creative space, the question really is that, do you dominate US or you don't dominate? And it doesn't really matter what you do in the rest of the world. If you're not winning in US, someone will win you. And if you win in US, it's enough to win in the rest of the world. So that's been maybe the hardest part. And it took really long while for us, probably 6-7 years to really start to crack US. And we actually need to sell big part of the company for Providence to partner with them. And only during the past year, together with Providence and Laura Desmond, who is our chair of the board, who has a great experience building DoubleVerify and being on board of Adobe as a whole, and being running one of the most successful marketing agencies in US, Starcom. Only with that kind of experience during the past year, we've been actually able to build our US leadership team, commercial leadership team, hiring the new CRO and hiring a new chief commercial officer as well. And step by step, we are kind of building the commercial team from marketing to sales to customer success in US. And then the product and the engineering team in Finland, and that's been really a transformational. We were not able to find the right talent from Europe to be able to crack the US markets, and that's been important and tough.
Super, thank you, Chris. Interesting, and congrats on the progress in the US. I know it's not been straightforward. Maybe back to you, Henri. I guess anecdotally, I feel like there's probably more repeat founders in the ecosystem these days. Be interested if that's what you're seeing, and A, repeat founders, and B, founders whose ambition is now multi-billion-dollar companies rather than single-billion-dollar companies. Is that what you're seeing in your investment work? You might be on mute.
Yeah, 100%. You're looking at our own data. In the past 5 years, we went from 25% repeat founders, we're back to today around 50%. So the executive talent and the founding talent is clearly increasing, and something we see about what drives this will to go higher, like to go to the 5 and 10 billion and not stop at lower levels, is usually they've had a first success, and this first success was a good exit, not a massive exit, and so they're coming back. They know what they're doing. and there's no need to do an early exit to to make let's say a few million, sometimes even a few tens of million. And we've seen in our portfolio quite a few founders saying no to €1 billion exit, just because this is not what they are interested in. Maybe there's been a bit of secondary along the way, so that if there's some let's say current cash needs, this can be dealt with. But clearly, repeat founders, not only they have the skill, but they also have the financial possibility to go further without too much, let's say, personal pressure.
Interesting. Yeah, sure. And that's, I guess, I see a little bit myself as well. Maybe let's move on to topic number 2, which is around product, service concept and market fit. Again, question for you, Fergal, which is probably a little bit of my observation, but I'd love your view, is it seems to me historically that there's been a lot of consumer internet companies funded and done well in Europe, but we've seemed now to have a very broad-based or a broader-based ecosystem of SaaS companies. And I'd be interested, A, if that's your experience, and B, if that is right, what do you think has driven that potential transition in terms of business model here in Europe?
Yeah, I don't think it's anything specifically related to SaaS per se. I think it's more related to the fact that the market has just matured in Europe in the past 10 years, 15 years for sure, but rapid maturity in the last 10 years. And what I mean by maturity is, I mean more capital, I mean smarter capital. And when I say smarter, I mean people who are well informed on how much it's going to cost to scale a software company like Christos, to really break into the US market, to get the right people in at the leadership levels, etc. So I think while Europe did very well early on in consumer-related plays, and that continues, by the way, initially it was kind of on the back of copying US models and replicating them in Europe. And then things like Bon Privé and so forth started to happen, where European models were copied into the US. And I think that specific case actually is one of the situations that gave Europeans a bit more confidence in our own ability to create models that suit our markets. Now, coming back to your question around SaaS, I think you could apply the statement, generally speaking, to software company development. The fact that SaaS happens to be the hot and relevant architectural model and financial model is almost irrelevant, because there's nothing peculiar in Europe. We've got the universities, therefore we've got the tech talent at the coder level, engineer level. I think what we missed for the past 10 years, it's improving, and we're still not at the US level in this regard, is product management capability. I think that's one role. If you go to any company in the SaaS or software world across Europe and ask them what's the hardest person to hire, and they will probably say, I can get the tech talent, I can get the engineer, but I'm struggling with product. And you go to some of the universities and ask them, what are you doing about product development? And they don't really know what you're talking about. And that's a miss, in my opinion, in Europe. You go to Stanford, MIT, any of the best universities in the US, they've got extraordinary product management courses specific to our sectors, our industry, whether it's consumer or SaaS, B2B related business models. We have industrial engineering here, which is close, but not close enough, in my opinion. And we need to get a bit closer.
Fascinating. I agree. Interesting. I completely agree, Fergal. Fascinating. Let's maybe move on to the third point, which is around funding and execution. And Christo, I know you spend a lot of time, or maybe not too much time, outside of your day job in the startup scene in the Nordics. And I'd love just to hear your views on how the funding environment might have changed for startups over the last few years, maybe looking back on your experience of raising seed capital for Smartly and how the scene is looking these days.
Yeah, absolutely. And it has definitely evolved a lot, but I have maybe a bit controversial view to the funding. I do think that you need to build a business and you need to build a fast growing business, and you need to build a profitable business. And that's how you are able to prove that your and I'm talking about SaaS. I understand SaaS, not consumer, and it's different dynamics. But in SaaS, that's how you prove that you actually add value to the customers. And then the funding will come. I've always told, and I always thought myself, that the funding is not a problem if you can build a business. Like when you are profitable and you are growing fast, you'll get the funding if you need it. But then there is way too many businesses who are focusing on raising funding instead of building a profitable business and serving actually the customer needs. So that's kind of my take, and it's a bit, and there is huge amount of successful companies that has raised tons of funding in the early days and never been profitable, and that's a different model. It works definitely, but my model is different. but I mean, there is a lot of cash, but I think there has always been enough cash available. Now I feel that there is too much cash available, that there is bad services and bad companies and bad teams that are getting too much funding, and I think that's kind of my very controversial thinking, but definitely like there is a lot of funding available at the moment for sure, which can be good or can be bad in the long term. Depends which companies you pick as an investor, obviously, and that's my view.
It's interesting, Christo, and actually I'll pick up on that topic maybe with you, Omri, about the supply of capital these days, because I think, you know, the stats we're seeing about the inbound investment is extraordinary. And it seems to me that a lot of capital is coming from new sources, whether that's sovereign wealth funds, hedge funds, mutual funds, private equity firms opening growth funds. Seems like there's a supply of capital is not the issue anymore. Just be interested to build on Christo's topic there. How are you seeing this big supply of capital affecting the funding environment and your ability to win deals here in Europe?
Oh, that's a fascinating question, and you know, a year and 3 months ago, something like this, I'm sure a lot of people had a lot of you know, forecasts about what's going to happen, and everybody's fighting the last war, and everybody was looking to you know, 2008 or 2000 and think that there will be you know, scarcity of capital, and we're seeing exactly the opposite. So a lot more capital from all of the sources you mentioned, plus SoftBank, you know, asset class in itself, in terms of the amount they deploy. And the interesting thing with the past 15 months is the world has become flat, right? So for a founder, it's very easy to run a fundraising process quickly with multiple investors, and they're all on Zoom. And on Zoom, everybody maybe has the same taste of money, right? Because you cannot differentiate by being closer, coming, spending time. The chemistry of a Zoom is, I don't know, Christo can tell us more about that as an entrepreneur, but it's slightly harder. And so I think it has brought both opportunities, especially when you're on the sell side as an investor, and challenges on the buy side, you know, when we're trying to invest. And what that mean is we've tried at Partech at least to be a bit more creative in the companies we're pursuing, in our deal making. We've still managed to invest only over the past 15 months in companies that founders that we've met face to face, sometimes doing you know, the odd journey in you know, sometimes you cannot go to that country, so both the founder and us go to a third country that accept both, so you need to also be creative with the travel restrictions. But anyway, yeah, creativity, as far as we're concerned, is necessary, because for the, let's say, the perfect asset, perfect deal situation, etc., there is so much money that, as far as we're concerned, we don't think that's a good place for us to compete.
Interesting. Maybe Phil, a little follow-on question for you, I guess, is to build on Omri's topic there, is how do you at Highland try and compete in this environment to convince founders that you're the right team and the right capital for them?
That's a nuanced question, Ben, because we like to think of ourselves as being kind of the nice guys. And to prove you're the nice guys, I'm going to borrow Omri's expression that the chemistry of Zoom is super difficult. It just doesn't work, right? Because what an entrepreneur feels when they walk in your office, not from you so much, but how they're greeted, the atmosphere of the place, you know, the warmth of the greeting, and let's say it's a no meeting, it's a no situation. The nature of the no and the way in which it's delivered, it's always better in person. There's no question about it. So that's a big, big challenge. I personally, Q1 last year in the middle of COVID, told all my investors, I wasn't speaking for the firm, I wasn't speaking for my other colleagues. I simply said, me, Fergal Mullen, as a really outgoing kind of sociable Irish guy, I'd find it hard to invest in a company and a group of founders that I haven't met. And in the following 3 months, what do? I go and I do just that. I invest in a company in Istanbul. And the only way I could get through it was to kind of triple down on the meetings by Zoom.
Right.
I don't know if it's too early to tell, Ben. The company's going pretty well, but I don't know if that's the right approach, but it was the only approach I could take at the time. So I had a choice to either be in the market or exit the market when everything was in lockdown. We chose to be in the market. We made 7 investments last year. It was probably our busiest year ever in terms of deployment of capital. And most of the investments, I would say, we had met the entrepreneurs before, others not. But we kept trying to sell. So we do pitch decks. So we pitch entrepreneurs in the middle of an investment process. You're not supposed to hear that, Omri.
It's the same.
It kind of pleasantly surprises most entrepreneurs, and it's for me it's a way of saying thank you for your time. You come in, you give us hours of your time, and we give you nothing back. Sometimes even very poor feedback. When I say we, I mean we as an industry. And I think the entrepreneurs deserve much more than that. So we often turn the screen around and say, well, let me tell you all about us, and let me tell you why I think we're the right investor for you right now. And we'll talk about our experience in bringing companies to the US. We'll talk about our experience in recruitment and helping get in at the CXO level and building a balanced board. We'll talk about our network with the great bankers of the world, like Macquarie, of course. And that's the kind of thing that resonates. It's better in person. And we just had to figure out a way to replicate it in the Zoom world.
They're fascinating for them. They're very honest and interesting feedback, actually. I'm delighted that there's other industries using PitchBook still. That's excellent to know, given how much we do. But no, thank you. Really helpful answer. Maybe just the last topic, and then maybe some questions from the audience here. If we talk about exit routes for European tech companies, my experience is that strategic buyers exist, private equity buyers exist. The capital markets are still a long way behind the US. So I always, historically, even taking companies on roadshows was blown away by the depth of knowledge of US investors about business models and valuation metric approach versus sometimes what you find here in Europe. So I don't know, would be interested, maybe Omri, to get your perspective on the European capital markets and the IPO markets and how they look versus the US. I think one of your companies priced its IPO, I want to say yesterday in the form of Made.com. So congratulations. But it would be great just to get a perspective on the capital markets from your side.
No, great. Look, in terms of, let's say, liquidity for investors such as us, so private equity for, minority or majority buyout, Christo knows this very well, strategic or public markets. If I start with the minority or majority buyout, that's great. There's a lot of dry powder. It applies for companies that are either very profitable, such as, Smartly, or at least break even with a promise of profitability. So if you are a heavy losses kind of startup, super fast growth, this is not going to be for you. But if you are not too far from break even or profitability, it's definitely something that was not so common 5-7 years ago, and now it's massive. So very important. With regard to the strategics, this one is tricky in Europe because the European strategics, just if you look at the market caps on the FTSE or on the CAC 40 or the DAX, etc., those are very tiny compared to the valuation of tech companies. And so strategic acquisition will mostly come from the US. And that's just a fact. You may have for a few $100 million valuation. You can have European acquirers, but in general, the answer will be US, maybe China, but not in Europe. And then the public markets. We did have it was our first investment in 2015 with a fund. So we're happy about the float of made yesterday, billion plus. We're happy about that. There would be more where that came from. It is a consumer business, and it's a consumer business, meaning that the public market investors know what they're looking at. They are European comparables, so they understand all of this. When you go into more, let's say, hairy business models, it may be slightly more challenging in Europe than in the US. And this is where maybe SPACs, to some extent, can help. And we think there will be more on this route. We think it's an interesting mechanism.
Great, thank you. And maybe Fergal, just quickly, because I know you started your career in the US, do you still see fundamental differences between the IPO market in the US and Europe?
Yeah, I mean, I think Omri's covered some of the topics. It's not just about depth of market, it's about the knowledge of the investor base. I mean, they're just streets ahead. And they'll buy an IPO like a growth investor in Europe will buy a Series D round, right? They just look at it as another step in the overall capital journey. And until our public market investors, and by that I mean the pension funds, the mutual funds, the equivalent of mutual funds over here, etc., across the entire continent, buy into that, we're always going to be a bit behind. Consumer companies get public here no matter what exchange, because as I said, it's easier to understand. Plus, you can build a big business as a consumer model just in Europe. Even covering just 2 or 3 of the bigger countries, you can be really big. Whereas on software SaaS, as Christo noted earlier, to be really successful, you need to crack the US market. Therefore, if you crack the US market, you might as well go public on the US market because they understand your model better. There's a deeper capital base there, and selling the IPO, assuming the window's open, will just be easier. So we don't just have to improve in Europe, we've got to more than improve to get anywhere close to the US on the software side of things.
Makes sense. Thank you, Fergal. I've got a couple of questions coming from Q&A. Maybe I'll point this one towards Christo, actually. Is in terms of Europe is obviously not a single market anymore, and never was in some ways, but do you find local market conditions in certain geographies in Europe make it tough for you, or is it in fact easy to sell across geographies in the SaaS world and the social media world?
This is an excellent question, and I'd like to put it to the framework of building a successful company. And unfortunately, in SaaS space, building a successful company in US is faster and cheaper in a way than building it in Europe, because you have one market, one language, one culture, and your salespeople from New York can cover the whole US. And that's why a lot of the US companies grow so much faster and then buys a European company that maybe has a better tech and product, but they've not been able to grow that fast because there is tons of complexity. And that's a challenge. I think in Europe, you need to be able to build a go-to-market for each of the countries. You need to have localized salespeople, localized marketing materials, and you need to be present in those countries like Germany, France, and UK separately. We, at least, were not able to do it from Helsinki, Sweden. We were able to do it from Helsinki, but that's about it. And for us, Nordics, so Sweden and Germany, has been the easiest and the kind of the best markets for long. And then UK and France has been extremely difficult markets for us for long. Now, during the past 2 years, we cracked UK, but France, we have still a long way to actually crack, for example. So that's been really tough market for us as Smartly.
Thanks, Christo. Super clear. I think we're very up close on time, but maybe I'll ask a super quick question. And maybe to Fergal, what one thing do you think governments could do better to actually improve the ecosystem in Europe?
Oh, I'm going to take it away from governance, Ben, and shift it towards stock option regulation. If we had a uniform tax regime across all the various markets, it would be so much easier for Christo to hire a German or a Swede or a Dutch person or a UK person or a French person. We're just something uniform, simple, fair tax treatment, and no upfront cash on grant of the option. That's just disgraceful. We need to change that.
Helpful, thank you. And look, thank you to my three panelists. It's been an excellent and interesting discussion. I'm actually excited personally. It's clear to me that the European tech scene is in great health. Whilst there's some way to go, I think we've made great strides towards becoming, a unicorn factory in terms of a geography that's approaching out of the US. So thank you all for your time, and I look forward to speaking soon.
Thank you.
Thank you.